Swayam Prabha. Digital India. Educated India.
Welcome to another session of corporate finance. So far in the last couple of classes of corporate finance, what we have looked at? We have looked at the asset side of corporate finance balance sheet out there, I am sorry. Asset side of the balance sheet. When I say asset side of the balance sheet, we looked at the investment, we looked at the NPVs, we looked at the IRR, that is internal rate of return. We looked at if I am going to invest my money in this particular project, what is the kind of return I am going to get with the time value of money. If I am going to invest in the other project, what is the kind of money that I am going to get, and so on and so forth out there. Now, I move to the other side of the balance sheet, that is equity and liabilities part of it. When I am going to talk about the equities and the liabilities part of it out here, I am going to look at the core aspect, as you can see on the screen, the risk and return aspect out there. There is some element of risk, there is some element of return, and so what is the belief? If you ask a layman, they would say, oh, high risk, high return. Please note, nobody guarantees you high risk, high return. High risk means higher expected return. The word expected is very crucial out there, because high risk, higher expected. The moment you start taking high risk, nobody guarantees you a high return. You are expecting a high return out there, that is where you take a higher risk and so on and so forth out there. Now, let us start with the basics as we go along in this particular class out here. I am picking up some newspaper article out there, newspaper headlines out there. Recent headlines on newspaper, it says up to 35% return in 2023, these sectoral indices have substantially outperformed the BSE Sensex this year. That is, it is giving me some index of the sector, that is, it says capital goods has performed about 35% returns, and reality is giving me 29% return. Auto index is giving me 23%, FMCG is giving me 16%, and healthcare is giving me 21%. So, these have outperformed the performance of the index itself, the sectoral index. These have outperformed the overall index itself, that is, they have performed better than the index out there. But on the other side, I also have, there are some sectors which have not done greatly. Let us say oil and gas index has down by about 8.4%, whereas power index is down by about 5% out there. So, what am I trying to communicate out there? That is, when I say, when I invest money, risk is an important issue. If I had taken, what do you call it as, invested all my money in BSE capital goods index, after I got a return of 35%, I am very happy about it, fantastic. But if you had taken your money and invested in oil and gas, you would have got a negative return of 8.4% out there, negative return of 8.4%. So, you could have, the probability that you would have lost most part of your money is also very high out there, and that is what we call it as a risk is always on the downside. So, what are we looking at? That is, when we say the movement forward or there is a positive movement, it is not that all the stocks, all your sectors are doing exceedingly well. There are some sectors which does well, some sectors which does very poorly. So, what happens? We are looking at balancing these things, that is, we are looking at diversifying your portfolio, so that you are able to manage your risk out there. If I had put all the money in one sector, whether if it's power index, power or oil and gas, probability that I would have lost all my money or I would have not had any return, I would have had negative return is very, very high. So, what I would do? I would sort of spread my money out there. So, I might not overall, I may not get 35% return, but I am getting a sort of positive return, that is, some negative returns are getting offset by some positive returns and so on and so forth. So, I am basically able to balance it out in the whole process. That is the reason I basically put that. I move even to the next level. I am looking at stocks. Let us look at manufacturing. That is what we said in the earlier case. We said what you call it as capital goods index, and BSE is 35% is the movement, that is it has moved up. Now let us look at capital goods. Let us look at Tata Motors and let us look at Reliance Industries. If you look at Tata Motors, it has moved up by about 56% in the last year. The stock has moved up, the price of the stock has moved up by about 56%. Capital goods, because if you say, whereas capital goods moves up only about 35%, whereas Tata Motors has moved up by about 56%. Whereas when I look at Reliance Industries out there, it has moved down by about 5% out there, negative growth of 5% out there. Now, if you look at even the previous slide, there is a healthcare is about 21% out there. If you look at Reddy's, it's moved up about 33% out here, what you see. If I look at the banking, it has moved down by about 70. So, what happens? Even in a sector, all industries are not going to move at the rate of 35%. There are some which are like Tata Motors, which are exceeding in the last year. Maybe it was a favorable year out there. So, what happens? Tata Motors out there, if you moved up by about 56% in the last year, Reliance moved down by about 55% out here. So, what happens? Even within a sector, I am diversifying my investments out there to manage my risk out there. If I had invested all the money in Reliance, my returns would have been down by 5% last year. If I had invested all the money in Tata Motors, sir, you would have gained 56. Yes, agreed. But risk is not always on the upside, risk is always on the downside of it. So, what you are looking at is you are diversifying out there. So, these are all value, I am talking about value stocks. So, what are we looking at? I am looking at, in this particular case, I am emphasizing on risk aspect. How do you mitigate that risk out there? You mitigate the risk by first thing diversifying out there, whether it is sector, in a sector, various companies and so on and so forth out there. So, then the next question is, there is a tremendous profit potential, but there is also a risk of losing money out there. So, what is it that you as investor are expected to, or what should you as an investor expect when you invest money, your own money out there? What is it that you expect? Let us take some examples out there. I have taken rupee returns out there. That is, when we normally look at, when we talk about returns, we classify returns into two basic aspects of it. One, return in the form of dividends. I am talking about investment in equity, I am not talking about investment in debt at all. Debt means debt, of course, there could be a capital gain marginally, that let us keep that aside. We are talking about investments in predominantly equity. When you invest in equity, there can be two sources of return. One is the company declares a dividend. There is some money you earn, that fantastic, right, dividend. The price in the market can also move. Now it is January 2024 and we see that the market is still what you call it as moving northwards, and there is also a capital gain between the money that I would have invested last year and sometime last year and current and as of now. So, that difference is what we call it as capital gain, that is the value. I imagine I bought a share at about 150, the value of that share is about 300 as of now. So, 150 rupees I gain because of the movement, the price movement of that particular equity itself. Plus, if they have declared any dividend during the period I am holding, that also becomes my gain out there. So, normally returns come in two form on your investment, dividends and capital gain out there. I am going to take an example out here. The example that I have taken out here is, supposing you are investing money, you are buying 100 shares of a particular company at $37 or 37 rupees at time 0, that is, let us say time today. You are holding it for a period out there, whatever is the period, 1 month or whatever it is, you are holding it for a particular period out there, and during that particular period the company gives you a dividend of 1.85 per share out there. So, you hold 100 shares, 100 into 1.85, $185 is the rupees is the dividends that you have earned by holding that particular share during the period. That is, you bought it at 37, the cash outflow is 3700. inflow is 185 as you can see on the screen, and then I move on, and then you decide to sell the shares out at the end of whatever the period out you are holding. The price of the share has moved up from $37 to 40.33 in the market. So what happens? Let us not worry about the transaction cost as of now. We are talking about the net price out here. So let us say you sell it at 40.33 net after absorbing for the transaction cost. So you are going to get 100 plus 40.33, $4033 is what you are going to get. What is your outflow? Outflow is 3700. What is your gain? Gain is 4033, the amount I have got by selling the shares, plus 185 what you see on the screen, that is the dividend income, minus the 3700 is what we call it as the initial investment. If I say, supposing in this particular case, what is the capital gain? Capital gain is 4033 minus 3700 is the capital gain out there. That is what I have given out there, 40.33 minus 37 into 100, that is 37 the price you bought, 40.33 the price you basically sold. Supposing the price had gone down from 37, it had gone down to 34.78. There would have been no capital gain, there would be a capital loss 34.78, and you sold the shares out there. Sir, why will it sell a loss? Suppose you need money, there is urgency for you to need money, so you sell it at a loss, you sell it at 34.78. That means what? You have basically lost roughly about 37, and then you have roughly lost about 2 rupees and 22 paisa, 2 rupees and 22 paisa per share, 2.22 per share. So what happens? Your net loss is about minus 222, whereas you have gained 185 in the form of dividend. So your net loss or gain is minus 222 plus 185 will be your net loss or gain in that particular case. Let us say in this particular case out here, in this particular case, let us go back to the original case of 40.3 selling at 40.33, your total gain is 518, or I can just put it the other way around, that is 3700 plus 518 is basically what you have basically got, or I can say that 40.33 into 100 plus what do you call it as 185 is 42.18 is what you have got. Whereas if I had sold it at a loss, then what would have been my gain, my net loss? My net loss is 222 minus 185, minus 222 plus 185. 185 I have got it in the form of dividend, 222 is what I have lost, that is 22 plus 15, 32, 37, that is you have got your net gain is minus $37. Your net gain will be minus $37 in that particular case out there. Moving on. Supposing I don't sell the stock, I hold and hold it, I don't sell the stock at the year end, you can still consider capital gain as part of your return? That is the next question. Imagine in this earlier case, what happened? The capital gain is considered because you have sold the stock. In this case, I am not selling the stock, the capital gain be considered as part of your return out there. There are two ways of looking at it. One is for income tax purpose or tax purpose. The other is looking at the gain that you have. If you want to calculate only the gain that you have, yes, I will consider the capital gain also that has occurred during the holding period out there. I am not sold it, but I know what is it I am sitting on, what is the value of the shares that I am holding on to it. So there is naturally what happens, you are already considering the capital gain. Whereas you are not accounting for the capital gain, let me bring the role of accounting here. You are not accounting for the capital gain for a very simple reason. If you account for the capital gain, then what happens? You have earned a profit and the profit is not realized in this particular case. When profit is not realized, then you are not going to pay what is called as capital gain tax on it in the process. So, if for accounting purpose, from the point of view of accounting, from the point of view of income tax purpose, I do not consider capital gain until otherwise it is sold. Whereas, from an investor point of view, I need to know what is the value that it is worth or what is it worth. I will certainly look at the capital gain that I basically have got from that particular investment. Let us move on further. returns are always expressed in the form of percentages out there, convenient basically percentage summarizes. Then now question is, how much return do we get on a rupee invested out there, on each rupee invested out there? What is the kind of return that you need to get? Short and simple answer, the return that you need to get or the return that you are expecting or the return you want to get will basically depend on your risk appetite, your ability to take the risk out. Now that will depend on, that is all I said, it will depend on. I mean, if I am prepared to take a very high risk and prepared to take make investment in very high risky stock out there, then my return could be completely negative, where I would have lost all the money, or could be significantly positive, it could be significantly high. That can also basically happen in the case that is I have taken a very high risk. I don't want to take very high risk, I want to just put my money in State Bank of India fixed deposit earning about 6.2% out there. Risk is low, return is only very minimal, and return is nearly assured in that particular case out there. So the risk return relationship basically decides what is the kind of return that you need to get in this particular case. I am taking one more example out here, or the same example I am continuing. I buy the cash outflow for a stock at 37 rupees out there. I get a dividend of 1.85, perfectly alright. Ending market value is 40.33 at time t plus 1. My total inflow of cash that basically happens when I sell the stock is 1.85 plus 40.33, that is what we say 42.18 in this particular case. Whereas what is the yield out here? Yield, dividend yield. I did talk about it when I did the ratio analysis out there in financial accounting. If you go back to the lectures of financial accounting, I did talk about dividend yield in financial accounting. Dividend yield is nothing but whatever is your investment and what is the dividend that you are basically, I am looking at only the dividend. That is, I have invested about $37 or 37 rupees. I got a dividend of 1.85. So what happens? Dividend at t plus 1 at the time 1.85 divided by the initial price at 37, and that is what is my dividend yield. My dividend yield is only 5% out. What is the return, total return in this particular case? Whereas capital gain, the capital gain yield is, yield if I say expressed in a percentage, the price at which I am selling 40.33, the price at which I bought 37 divided by the price at which I basically bought gives me what is called as the return on capital gain. So the capital gain is 9%. My dividend is 5%. Overall, I have got a return. My total return will basically be about roughly 14% in this particular case. That is dividend yield plus capital gain yield out there, capital gain expressed in the form of a percentage. So what is happening? I have got my 14% is the kind of return that I have got on my investment, both dividend and capital gain put together. 14% is the kind of return that I have got on my investment out there. So moving further in this particular case out there, that is how basically, that is what we saw in the earlier slide. I am just putting the earlier slide. That is how we always express in the form of percentages and percentage returns in this particular case. I have taken an example. What is the return? That is a company of coffee making by the cup fame began 2014 from at 74.54 per share. They paid dividends of $1 during 2014 and the stock price at the end of the year is 132.40. What is the return for the year? All these examples, let me tell you, I picked up only from the prescribed textbook. Now you can calculate out. Here, let us try and see if we can calculate it. I am going to use mostly the Excel sheet to calculate all this. My initial price is about 75. I hope my screen is visible. My initial price is 75.54. That is what is given out here. My dividend is $1. My ending share price is 132. I want to know first of all what is my dividend yield. My dividend yield is $1. I have got $1. divided by what is my investment. My investment, this is my investment, this is what we call it as my dividend yield. I have taken it, set it in percentage. So, what happens? This is what is my dividend yield. My dividend yield is 1.32% out. I look at my capital gain yield. My capital gain yield is very simple. The price at which I have sold minus the price at which I have bought divided by the price at which I have bought initially gives me what is my capital gain yield. My capital gain yield in this particular case, let me make it converted to what is called as a percentage out there. My capital gain yield is about 75%. So, what is my total return? My total return is dividend yield plus capital gain yield, that is about 76.32%, 76.60, because I have just, let me take the zeros out here. I have just taken the zero out there. Okay. So, what happens? It is 76.60% is my capital gain, or my total return. I am sorry, not my capital gain, my total return in this particular, for this kind of an investment that I have basically made out. It is a very simple thing. Now, I move on to the next problem out here. In 2014, GameStop's stock price at the end of the year was 33.80 per share and dividend was 1.32 or paid. The stock began the year with 49.26 per share. Now, what is the question? The question is, get me what is the total return of this investment out there. Get me what is the total return of this investment out there. Let us start off, try and see. I have not put the question here, but that is the basic question what I am trying to ask you. Let me go to my example 2 in my Excel sheet. So, if I look at this, what is the dividend yield? Dividend yield is very simple. Dividend is 1.32 is what I have got, and then I have the initial price is 49.26 out there, and dividend yield is 2.68% out there. What is my capital gain yield? Capital gain is very simple. The current price, selling price minus the initial price divided by the initial price itself. I know in this particular case it is a loss out there, that is the reason I gave you this problem. So, what happens? It is negative 13.4%, that is the price has moved, the capital gain yield is negative. But what is your overall return? Overall return is less than negative 31.4 purely because you have got a positive dividend yield out there. The positive dividend yield will offset your negative capital gain yield to a small extent. So, what happens? Your total return is only about negative 28.70% out there, negative 28.70% out there. I move on. I have taken 2 examples out there for calculating the total return and dividend yield, and then I am going to move on to the next example out here. The next example out here. Little bigger. Supposing a stock begins the year with a price of $25 per share and ends with the price of $35 per share. During the year, it paid a dividend of $2 per share, where the dividend yield, what is the dividend yield, capital gain yield and total return for the year. I am going to use Excel out. Suppose you had invested $5,000, 5,000 rupees, the total dollar return or rupee return, I mean I have used dollar and rupee interchangeably, please do not worry, there is a currency out there, that is all. I can correct this to what is called as the total rupee total, what do you call it as the rupee in this particular case, okay. I will say the total rupee return would have received, that you would have received on the investment in the stock is, what is it? The answer is sort of seems to be here, but do not worry about it. Let us try and see if we can calculate this whole thing out there. Let us go back to this Excel in this particular case. I am just going to zoom this a little bit so that it is easier, clearly visible for you. Let us go to example 3 in this category. What is my dividend yield? Firstly, let us say, what is my dividend yield? My dividend is $2, my initial investment is $25, and then this is my dividend yield is 8%. What is my capital gain yield? My capital gain yield is my what is called as ending price minus my initial price divided by the initial price out there, and that is what we call it as the total. What is my total return? My total return is about 48% is the total return out there. What is your investment? My investment is $5,000 out there, is 5,000 rupees is what I have invested out there. What is the rupee return on the investment out there? Rupee return on the investment is 5,000. On this 5,000 you are earning what is called as 48% out there, that is you earned about 2,400 as your return, and the total return what you have basically got is 48% or 2,400 out there. That is all that we will sort of look at in this particular case out here. I move on further from now. In this particular example, whatever we did so far, we did find out the return, that is clubbing the dividend return and the capital gain return, and find out the return. Return can be negative, that we saw. Return can be positive, we saw. Dividend return cannot be negative, so do not worry about that. Capital gain return can always be negative. Dividend return is not negative because they are not going to pull the money from you. So, dividend return can be 0 if they do not pay any dividend, or can be positive if they pay some dividend out there. So, that is what we talk, and then capital gain return out there. So far we looked at only the dividend return and capital gain return or the total return out there. We also said what is going to be your money that you are going to make if this is the kind of return, and what is the kind of money that you are going to make, and so on and so forth in this exam.